So as you can see from the content slide, what we'll take you through is, or what we'll be covering is how the McLeod age discrimination remedy impacts on annual allowances, what the annual allowance limits are, and the pension input period, the calculation of the pension input amount. We'll also explain the carry forward rule and how any carried forward amount can be used to offset a tax charge. We'll cover off what information is contained in your RPSS and how to interpret it. And then we'll move on to the actions that you need to take, covering use of the HMRC digital service, what scheme pays is, and when that can be used, and finally, the deadlines for submission to HMRC. Okay, so I will now hand over to Simon to take you through the slides.
Thanks, Tony. Good afternoon, everyone. Thank you for joining us. So I'm just going to start by giving a little bit of a recap on the age discrimination remedy. So McLeod or Sargent remedy, as you may know it. I'm sure you all know this background anyway, but I just thought it would set the scene before we then start to look at the impact that it's had on your annual allowance. So under the reforms that were introduced to public sector pension schemes in 2015, protections were provided for some scheme members, and those were referred to as transitional protections. So back in 2018, the Court of Appeal found that those transitional protections were discriminatory against younger members in the judicial and firefighters pension schemes, as they were only offered to older scheme members. So the government accepted that that applied across all public sector schemes, including the police and fire schemes. So to remedy the discrimination, from the 1st of October 2023, any pensionable service that you'd built up in the reformed scheme between the 1st of April 2015 and the 31st of March was rolled back into your legacy scheme, into the final salary scheme that you were part of before the reforms were introduced. So that period is known as the remedy period. And like I say, that process was known as rollback. So the reason why we're on this session today is to look at how that rollback has impacted your annual allowance for pension savings. So next slide, please, Tony. Thank you. So now we're going to look at what the annual allowance is. So the annual allowance is the amount an individual's pension savings can increase by in a year without having to pay extra tax. So if an individual's pension savings increase by more than the annual allowance, they will have to pay tax on the excess. Now the standard annual allowance is currently 60,000 for and that applied from 23-24 onwards, but prior to that it was 40,000. So for defined benefit schemes such as the police and fire schemes, it's a measure in the growth of the benefits that you've built up during the year. So it's not calculated on the amount of contributions that you or your employer have paid into the scheme. So that only applies to defined contribution schemes. So in the police and fire schemes and in other defined benefit schemes, it looks at how your pension benefits have increased from the start of the year to the end of the year. So each year we look at the growth in the pension value over the tax year, and that is known as the pension input period. Now, for many members, the growth in the pension during the year will be less than the annual allowance. So the people it tends to affect the most are high earners, members who've received a significant pay rise during the year, and those who've paid a significant amount of added pension contributions. But things such as double and weighted accrual can also impact your annual allowance as they escalate the rate at which your pension savings increase. So just moving on to the next slide. So as the police and fire schemes are defined benefit arrangements, the increase in the value of your pension benefits in a year is calculated by working out the value of your annual pension, so the pension that you'd accrued at the start of the pension input period. Then we increase that figure by inflation, and then we compare it with the value of your benefits at the end of the pension input period. So that inflation measure using the consumer price index is added at the start of the year just to, to level the playing field, to make sure that we are looking at the value in real terms in current prices. As the opening balance is calculated at the 6th of April, so the start of the tax year, it already includes the revaluation that was applied to the care benefits, the career average benefits, on the 1st of April. So just to look at how the annual allowance is actually calculated. To perform an annual allowance calculation, we need to know the opening and closing balance of the pension for the pension input period. So the pension input period is an agreed measurement and it currently runs from the 6th of April one year to the 5th of April the following year. So it's aligned to the tax year. So the opening balance is worked out by taking the value of your annual accrued pension before the start of the pension input period, increasing that amount by inflation, and then multiplying it by 16. The closing balance is then worked out by taking the value of your annual accrued pension at the end of the pension input period and also multiplying that figure by 16. So the pension input amount is the difference between the opening and closing balance. So you're probably wondering why we use a multiplier of 16. And quite simply, the answer is because that's what HMRC tell us to use for all defined benefit schemes. So the annual allowance applies to all pension schemes, not just the police and fire schemes. So if a member pays into more than one pension in a year, they'll need to find out the total increase in the pension savings across all the schemes that they're contributing to find out whether they've exceeded their annual allowance or not. So next slide. Thanks, Tony. So we've got here an example calculation of how annual allowance, the pension input amount, is calculated. So for this member, you can see that at the start of the pension input period, and we're looking at the period 2021 to 22, where the annual allowance was £40,000. At the start of the year, the member had accrued an annual pension of £28,113.49. Now, by the end of the year, that annual pension that they'd accrued had increased to £33,944.33. So to perform the calculation, we take that opening value, the 28,113, we multiply it by 16, and that gives us 449,815, and then we add on the inflation increase in line with the consumer price index. So for April 2021, that was 0.5%. So we're going to add that on. So that gives a total opening value of the member's pension savings, £452,064.92. So we then look at the closing value of his pension, and we can see that as the annual pension accrued had increased to 33,944, we multiply that figure by 16 again, and that gives a closing value of £543,109.28. So to work out the pension input figure, the difference between the closing balance and the opening balance was £91,044.36 for the 21-22 tax year. Now, as I said earlier, the annual allowance for 21-22 was 40,000. So that shows there that this member has exceeded their annual allowance by £51,044.36. So that is the figure that is potentially then subject to a tax charge. So next slide, please, Tony. Thank you. Now, if an individual's pension savings in any one year, including pension savings outside of the police and fire schemes, exceeds the annual allowance, then the excess is taxable as earned income. So as you saw in the illustration we just looked at, that member had exceeded their annual allowance by 51,000. So as I said, potentially that's going to be subject to a tax charge. That is unless they've got any unused allowance from the previous 3 years, which they can carry forward to offset any tax charge that may be due. So that means that even if the value of an individual's pension savings increases by more than the annual allowance in a tax year, they may not necessarily have to pay an annual allowance tax charge. So any allowance which is carried forward can only be used once, and there's a strict order in which the available annual allowance must be used up. So the way that it works is you have to use the current tax year's annual allowance first, and then any unused allowance from earlier years can be used, beginning with the available annual allowance from the earliest of the previous 3 tax years. So I've got a couple of examples on the screen here just to illustrate how this works. So looking at the example on the left of the screen, you can see here that in 22-23, this member's pension input figure was £50,000. So that shows that they exceeded the 40,000 annual allowance by £10,000. However, we can look back over the previous 3 tax years, and we can see there that the earliest of the previous 3 tax years was 2019-20. Now in that year, they only used 25,000 of the 40,000 annual allowance. So that meant that they had unused annual allowance of 15,000. So fortunately for this member, even though they've exceeded in 22-23, we can look back over the previous 3 tax years, and in that earliest tax year, 2019-20, they've got more than enough unused allowance to offset their excess in 22-23. So that means that they're not going to have an annual allowance tax charge because they've got plenty of unused allowance that they can carry forward. And you can see that in 2021, they've still got unused allowance there, and also in 21-22. So the following year, even if they exceed again, they will still have some unused allowance that they can carry forward. On the right of the screen, we've got a different example here. So again, this looks at the 22-23 tax year, and you can see again in this example, the member has exceeded their annual allowance. In this case, the pension input figure was 56,000, which means that they exceeded the 40,000 by £16,000. However, again, in this case, the member does have some unused allowance. So working back 3 years, the earliest of the 3 previous tax years was 2019-20. The member's pension input figure in that year was only 35,000, so they were 5,000 under the annual allowance, which they can carry forward. So that, obviously, they're exceeded by 16, so the first 5,000 of that we can take from 2019-20. We can then look at 2021, and in that year, the pension input figure was 30,000. So that means that they had unused allowance of 10,000 from that year, which again they can use to offset the tax charge in 22-23. Now in 21-22, the pension input amount was 40,000, so that meant that they had no unused allowance because the annual allowance limit was 40,000. So in this member's case, 22-23, they've exceeded by 16,000, but fortunately they've got 5,000 from the earliest year and 10,000 from the next available year. So they've got 15,000 carry forward allowance, which means that they'll only be liable for a tax charge on £1,000. Okay, so you're probably then wondering, how does this impact your position with regards to rollback? So if you had pensionable service in the remedy period that was rolled back, the rollback will have changed the amount of pension that you built up each year. So that can affect your pension tax position for one or more of the tax years during the remedy period. So members who've been rolled back will see a change to the pension benefits, but some could therefore also see a change in the pension tax position, particularly if they've exceeded their annual allowance in one or more of the remedy period tax years. So for some members, they may already have paid a tax charge during the remedy period, which will now need revising. or they may owe tax for the first time. So one other point to note, if you're a high earner, so this is typically members earning over £100,000 a year, the annual allowance limit against which you're testing your pension savings may also have changed because of rollback based on the contributions that you should have paid into the legacy scheme. So that's why we've included details of the contributions paid within the remedy savings statement. So I'm now going to hand over to Julie, who's going to cover the RPSS in more detail.
Thank you, Simon. Good afternoon, everyone. If following rollback you've exceeded your annual allowance, you will have been sent a remediable pension savings statement for the tax years within the remedy period. Now, within this document, there are a lot of figures, and I'm going to talk you through them in a second. It includes the recalculated pension input amount for the remedy tax period years following rollback. It also includes the pre-rollback pension input amounts and any scheme pays elections that you've made. I'd just like to point out as well that when you look at the figures, it does give you a pension accrued figure. And when we have shown the rolled back figures, it doesn't include any scheme pays elections that you've already made in the value of your pension. Just in case you think it looks a bit high. Right, next slide, please, Tony. Right, so within the RPSS that you've been sent, there is lots of figures, and they are in tables with this green coloured font. So I'll just talk you through the different sections. So the first section is the pre-remedy period position. So this covers 2010-11 up to 2014-15. Now, we have included these figures so that you can make sure that if you happen to exceed in the early years of the remedy period, you can see what carry forward that you've got that Simon's just talked you through. So the columns are made up of, the first one is the pension input period. The second column is the standard annual allowance value for that year. Now, you can see that we have had different rates over the years. During the remedy period, as Simon said, it is 40,000, but before that we've had different rates. The next column is the amount of annual pension that you'd accrued at the end of that year. The next column is the pension input amount that's calculated for that year. And then the last column is any tax charges that you have already elected for scheme pays. If we go to the next slide, please. The next part of the statement is the position during the remedy period before rollback. So this is, for this you might have been in the 2015 scheme for the whole period. You may have been a tapered member, so you've got some of your legacy scheme and some care scheme. But so it could be a combination. So again, the columns are, the first column is the pension input years. The second column is the annual allowance figure. The third column is the pension that you'd accrued at the end of that year. The fourth column is the pension input amount that you'd accrued in that year. And the fourth column is any scheme pays elections that you have made already. Now, you may notice that for the first year, it's actually split between the 1st of April 15 to the 8th of July 15. And then we've got the 9th of July to the 5th of April 16. That is because during that year, the government transitioned all schemes so that they all had the same pension input period. Prior to that, the schemes could choose what their pension input period was. So when they transitioned everybody to the same period, they put in protections, and the protections were split up from the 8th of July onwards. So hence why you've got the two figures. Next slide, please. Now, this is the figures that cover the legacy position. So after we have rolled you back into your legacy scheme. So these are the figures that you need to be looking at when you're assessing whether you've got any tax due or not. So the columns are exactly the same. So we've got the pension input periods, standard lifetime allowance, the annual pension, the total pension input amount. The fourth column is different because this is where we're telling you the contributions that you would have paid in your legacy scheme. Now, we have actually titled up the scheme. So this is the Police 1987 scheme. Now, if during the remedy period you have been with another police force or another fire authority, the figures that we've quoted include all of the details from your current employer and a previous one if it's applicable. Thank you. If we look at the next slide, please. Oh, is that? I think we've gone too far there,
You
Tony.
jumped to there.
Thank you. Thank you.
Sorry, my apologies, Julie.
You're all right.
I'm skipping in yourselves.
So when you're revising or paying tax, HMRC has defined the tax years within the remedy period as being in scope or out of scope. I will explain what each of those means in a minute. So the out of scope years are 2015-16, 16-17, 17-18 and 18-19. And the in scope years are 19-20, 20-21, 21-22, 22-23. Although 22-23 is outside of the remedy period, it's classed as in scope because we didn't roll members back into the legacy scheme until the 1st of October 2023. So we'll look at the out of scope years now. Next slide, please, Tony. All right, so the out of scope tax years, which are 2015-16 up to 2018-19. If during those years you have now got a new annual allowance tax charge, you will not need to pay that tax charge. If you've got an increase to an existing annual allowance tax charge, you will not need to pay for that tax charge either. If you have happened to have overpaid an annual allowance tax charge, you can apply for compensation for that overpaid tax. Now, what happens is when you use the HMRC digital service, they will tell you whether you can apply for compensation. And how you get that compensation depends on how you paid the original tax charge. If you paid the original tax charge yourself, you can apply to the scheme manager for the compensation. If you utilised Scheme Pays to pay the original tax charge, what will happen is we will reduce the debit to your benefits that relate to that Scheme Pays. Next slide, please, Tony. Too far. Sorry, so the in-scope tax years are 2019-20 up to and including 2022-23. If during these years you have now got a tax charge, you will have to pay that tax charge. If you've got an increase in your annual allowance charge, you will have to pay that. Again, if you've got any overpaid tax charges, this will be paid out again as compensation. And again, depending on how you paid the tax charge, depends how you get that compensation. If you paid the tax direct to HMRC, they will refund the overpaid tax for these years. If you utilise Scheme Pays and it's overpaid, again, we will reduce the debit on your benefits for the overpaid tax. Next slide, please. So presumably everybody on the session has had one of the remedy pension savings statements. So what you now need to do is you now need to use the HMRC digital service, which is called Calculate Your Public Service Remedy Adjustment. So you need to go onto the system, and when you go onto the system, it will work out any tax that you owe, any repayments that you are due, and you can also submit the information to HMRC on the digital service. Next slide, please, Tony. Now, before you start to use the digital service, you can register for the Government Gateway And when you go on to the link on the previous page, it's got a whole raft of information on that page, including how to register for the service. You need to gather all the information that you need before you complete the submission. There is a section called Before You Start that lists all the information that you will need. There is also a section called Information on What You Will Need and Guidance to Questions You Will Be Asked. And there is also a link to a YouTube video which talks you through completing the submission. And when you watch the video, on each page, it actually highlights where you can find the information for each page. The submission will also ask you for your pension scheme tax reference number. Now, this number is in the RPSS document that we've sent to you, and it's just underneath all the tables with all the information in, so your reference number is there. The system that you use, the HMRC digital service, although it is a HMRC system, it isn't actually linked to their main system. Therefore, it asks you for all the information. If you have previously completed a tax return, it won't link to that information, so it does ask for a lot of information. And the details that you will need will be to cover from the period 2015-16 tax year up to and including 2022-23. Next slide, please. Now, when you log on to the digital service, you can go onto the link and you can start to submit your information, or you can register and log in through your government gateway. Please please register and log in through the government gateway, because if you don't, you can't save the data as you submit it. So what that means is, if you get halfway through the submission and you've not logged in through the government gateway, and then you find out you haven't got all the information that you needed, when you come back, it may have timed you out and you would have to start again. So I can't stress that enough. To save time, please do register through the gateway. We've also been advised that you should make a note of the details that you enter, as we understand it that once you submit the data, it can't be recalled either by yourself or by HMRC. Before submitting at the end, when you come to submit, before you submit it, do save a PDF copy. However, we do understand that not all the data that you enter is shown on this copy. So as at the second bullet point, it says keep a note. Please do keep a note, because if you have submitted anything wrong on your submission and HMRC asks you to start again, you do need the information to hand. Whilst you're doing your submission, if you are unclear on anything at all as to what it means, what they're asking for, please do contact HMRC. The email address is on the slide there, or you can telephone them. The number's on there, and you select option 1, and that will take you through to the correct people. HMRC have said that if they're unable to answer your query by email or over the phone immediately, they will offer a telephone appointment so that they can talk you through. Whilst you are completing the submission, if you are doing it yourself, you can elect to utilise Scheme Pays during the submission. You do need to complete your submission by the 31st of January or 3 months after receiving your RPSS. So I know quite a number of people on the call today have only recently received their RPSS, so you have 3 months from the date that you receive it to complete your submission. Next slide, please, Tony. If you do have an annual allowance charge because you don't have sufficient carry forward to offset it, you have 2 ways of paying the tax charge. Now I'm going to talk a lot about one of the ways and not very much about the other. I always say at this point, it doesn't matter to us how you pay the tax. We're not trying to sway you one way or the other. You just need to pay the tax one way or the other. So the two ways are you can pay the tax direct to HMRC. So basically you send them a BACS payment transfer from your bank account. Or you can utilise Scheme Pays. Now, as the name suggests, Scheme Pays, the pension scheme will pay the tax to HMRC on your behalf. And what we will then do is we will then work out a debit to be applied to your pension, and that debit will be applied on a permanent basis. Now, when we work out the debit, we look at the amount of tax that you have to pay. We also look at the age that you were at the end of the tax year that the debit applies to, and we use a government actuarial factor to work out what the annual debit is. Now, when we work out that debit, it is based on the assumption that for the legacy scheme, you will be retiring at age 60. Now, we know that most people tend to retire before they're 60. So if that's the case, what happens is when you do retire, if you're retiring before 60, the debit we apply won't be as much as what was quoted. And that is to take account of the fact that the debit is going to be applied for longer, because obviously you're retiring sooner. The debit is increased each year in line with inflation until retirement. In the police and fire schemes, in the 92 scheme, fire scheme and 87 police scheme, under the regulations, you were awarded a pension, and you can give up some of your pension in order to get a lump sum. If you have a debit applied to your pension, we apply that debit to your pension before we work out the commutation. So obviously by having that debit on your benefits, it does mean that your lump sum wouldn't be as high as you were perhaps anticipating. Once you've made an election for a Scheme Pays debit, it can't be removed. As I've said before, it is a permanent reduction. Now, I did talk about before that whilst you're doing the digital service submission, you can elect for Scheme Pays as part of that submission. Now, we appreciate that you could be electing for a debit when you have no idea what effect that's going to have on your pension benefits. So if you wanted to know what effect that would have on your pension benefits, you can ask us to send you a Scheme Pays estimate, and we will do that. And the way you request the Scheme Pays estimate is if you go onto our website, at the top of the website, there's like a banner and there's a contact us section. If you click on that, you fill in the contact form and you can request the Scheme Pays estimate from us. Next slide, please, Tony. Right, so if you do want to request Scheme Pays, there are two processes depending on whether you're completing your HMRC digital service submission yourself or an agent is doing it for you. Now, when it says an agent, it's referring to a financial advisor, an accountant, a friend, a family member, anybody other than yourself. That's what an agent means. So if you're completing the submission yourself, as part of the submission on the digital service, you can elect for Scheme Pays. What will happen then is HMRC will advise the scheme manager that you have made an election for Scheme Pays. They will then tell us. We will work out the debit that's to be applied to your benefits. We will send you a letter to confirm that the debit has been applied to your benefits and what that debit is, and then we will instruct the scheme to pay the tax to HMRC. If you have an agent who's completing the digital service, because it's not you that's doing it, they cannot elect for Scheme Pays as part of the submission. So what would have to happen there is you would need to request a Scheme Pays election from us. We will send you the quote and an election form. If you wish to use Scheme Pays, you would complete the election form, send it back to us. We will then apply the debit to your benefits, confirm to yourself that we've applied the debit, and then we'll instruct your scheme to pay the tax to HMRC. And then the next slide, please, Tony. Now, everything we've said so far, everything I've said about the pension savings statement has covered the remediable pension savings statement that covers the remedy period. So for 2015-16 up to 22-23. Some people on the call may also have received a pension savings statement for the tax year 23-24. The digital service only covers the remedy period. So if you have also had a pension savings statement for the tax year 23-24, it's the normal HMRC service. The link is on there that you can use to work out if you have a tax charge. For the year 23-24, you do need to report any annual allowance excesses to HMRC using the self-assessment. The deadline for self-assessment is the 31st of January. That is a hard deadline. It's not 3 months after you receive your RPSS. It is the 31st of January. And if you do wish to utilise scheme pays for that year, those requests do come through ourselves, as there's no provision when using the self-assessment to elect for scheme pays. Next slide, please, Tony. So can we advise you what to do next? Unfortunately, we can't. All we can do is give you the facts, which is what we've covered. You can seek independent financial advice if you wish. Will I get a tax charge if you exceed? Yes. And if you use the digital service, that will tell you if you've any tax charges. And the information that you need for the digital service is, again, it's on the digital service webpage, because depending on your circumstances, depends on what information they will ask. Does anybody have any questions at all?
So just before we take any questions, Julie, Simon, I will stop recording, obviously.
Yes.
Just in case we have anybody raises any personal questions. Okay.
Right, Andrew.
Good afternoon. Thanks very much. A lot of information.